What's up, everyone? It's Kadi with MoneyVest. So welcome on board for another Market Open live stream. And today we've got the unemployment numbers. It's the first jobs report for 2024, and that's going to be for the month of January. So I'm going to go over some of the expectations and also break down, of course, the technicals and fundamentals of individual stocks, because we are seeing a lot of momentum, of course, for Meta after reporting a very, very strong quarter, and it's trading as high as $454, up about 17% pre-market right now, on the back of also its first ever dividend of 50 cents that they are going to pay out on March 26th. Amazon also reporting a very stellar numbers, over $1 in earnings per share, with the revenues jumping to over $140 billion year-over-year growth, and guidance for about 8 to 13% growth in the first quarter 24 as well. So we've got lots to break down. Apple's Vision Pro also going on sale today, and also we've got Apple stock right now down about 3%, close to 3%, and unemployment numbers come out in under 30 minutes. Jerome Powell's speech was already covered on Wednesday. I did a summary on Thursday, and today, again, is the last trading day of the week, and last trading day of course, for the week here. So if you guys can hear me and see me, just give me a thumbs up. I just want to make sure that the audio and the video is good. Just give me a thumbs up here in the live chat, and we are going to take a look at the unemployment expectations here in just a minute, and of course go over the actual numbers that are coming out in under 20 minutes now. So 170,000 is going to be that consensus, with the unemployment rate sitting at 3.8%, manufacturing payrolls at 5,000. And we've got average hourly earnings at 0.3%, and on a year-over-year basis at 4.1% is going to be that number. And then, of course, we've got the private payrolls expected to increase 142,000 as well. Definitely do participate in the live stream, in the chat, and also in the poll. We've got a poll going on right now. And what do you think the unemployment rate's going to be? Is it going to be above 3.8 or below 3.8 or at 3.8? Let us know in the poll as well. So definitely do participate in the poll here. Just give me 1 second. All right, so moving over to the market. So QQQ's, SPY, and Dow Jones, everything else is pushing higher on the back of course, earnings. So if you take a look at QQQ's, they're up over 1% right now, pre-market, 1.11%, of course, on the back of Meta, which is up almost 17% here. So actually, just give me 1 second. Okay, so coming back over to unemployment. So expectations-wise, 3.8%. So definitely do participate in the poll. And that is going to, once again, whether that's above or below or at 3.8%, that comes out in under 20 minutes. So definitely do participate there. And like I said, Meta up 17%, Amazon up 7%. Apple's the only stock that is selling off a little bit close to 3% pre-market, but markets, of course, still pushing higher to new all-time highs, with the SPY here up a little bit over 1%, also 66 basis points. So coming up to as much as 492. So that's going to be a new all-time high. And QQQs are up over 1.1% as well. So a very, very strong move to the upside. And the Dow Jones is also pushing higher. So we did see a little bit of rotation out of tech over to a little bit more defensive parts of the market. That's why the Dow was up over the last couple days, as the Nasdaq kind of struggled a little bit. Okay, so can't hear you. Is the audio good now? I just want to make sure the audio is good and you guys can actually hear me. I did put you guys on pause for a second, but I think it should be good now moving forward. So unemployment wise, this is very, very important, because and one of the things that's actually quite interesting is that Jerome Powell now mentioned that they are not looking for weakness in the labor market, right? That was something that they mentioned in the press conference, that they're not quite looking for weakness or softening the labor market, which is a little bit of a different tone from what they mentioned last year. Last year in 2023, Jay Powell and the FOMC mentioned that, they will welcome some softening in the labor market, But now in the most recent press conference from Wednesday, he mentioned that they are not looking for any weakness in the jobs market, and they're looking for or encouraging stronger economic growth, and they're looking for greater confidence that inflation is indeed trending lower. In other words, they're looking for that continuation of that good inflation data that they've received over the last 6 months. So Joel's numbers, 8.79. I think we did get the Joel's numbers earlier in the week as well. So if you come over to the Econ Day calendar, I believe we got the Joel's numbers earlier in the week. So we got on January 30th, so Tuesday, we got the Joel's numbers, which were again coming in with a little bit stronger, over 9 million jobs available in the US. So 9.026 is going to be that number. So we're going to update this to 9.026. We're looking for this ratio at 1.44. But the key here is going to be the unemployed persons. Unemployed persons is what we're going to be looking for. So if you come over here to this bls.gov website, anybody can go on this website, and this is all publicly available. This is all public data. So what I'm looking for here is a civilian unemployment. So if you click on this, hit go, and then you can see that right now, as it stands, we are at 6.2 million people currently in the US that are unemployed, right? So 6.2 million people of the participating population, which is, again, 166 million, is a 3.8% unemployment, right? So because that's the unemployed persons, that's the number that we have already plugged in. So that's the number from the previous report. That's why the unemployment rate is 3.8. Now look what happens when this number starts to go up. Unemployed persons, if it gets up to, let's say, 7 or 8 million or 10 million. So if we bump this number up to 8 million, then unemployment rate jumps to 4.8%. If this goes up to obviously 9 million, then 5.4, so on and so forth. And this right here is going back as far as COVID, the great financial crisis, the dot-com bubble, and the great inflation of 1970s as well. So just want to make sure the audio is good. It's good, audio good. And where's the green mic? So Patreon form not found. Trucking forever. So what exactly are you mentioning there? Just let me know and I'm happy to help you out. The audio should be good now, so I think we are good to go, and definitely do participate in the poll with the unemployment numbers, again, coming out in under 20 minutes. So if you go back to the great inflation, of course, the participating population was a lot less, right? We only had 105 million people in the US participating actively for employment. In the dot-com bubble, we had 137 million, 153 million during the great financial crisis, and 160 million during COVID. And now there's been an increase of about 6.5 million workers in the US as of 2024. So that's where we are, and the participation rate has kind of been around 60 to 65%. That's been kind of the normal level. And again, unemployed persons, if it gets up to 9, 10, 12, 15 million, then the unemployment rate will obviously move in that direction, which Jerome Powell also mentioned in the yesterday's or the day before meeting, that if there is weakness in unemployment, then they are going to be more, that's going to weigh into cutting rates sooner. But if inflation stays sticky and elevated and higher than what the Fed's target is, then that's going to weigh towards cutting rates later. So the bottom line is, I think we understand that rate cuts are coming. It's just clicking on your Patreon form sends you to page not found. Really? That's weird. Just you can go on this link, and then that should work. So that's the link. If you go on, and that should take you to our Patreon page at MoneyVest. Okay. If you have any other questions, let me know, and happy to help on the macro side, but then also on the fundamental side. So Meta obviously rallying quite a bit, 17%, huge breakout to a new all-time high. 50 cents is the dividend announced. That's going to be on March 26th. So investors can expect a dividend of 50 cents per share on March 26th, and the company's first ever cash dividend, as the cash has swelled from $40.7 billion to $65 billion. Now, the reason why this is such an important news, and of course they announced a $50 billion share buyback, and the reason why that's so important is because now it opens the door for pension funds, sovereign funds that are a little bit more risk averse, dividend investors that are now going to start looking into Meta more closely because of the dividend that they have announced. So that's a pretty big deal for Meta and Meta shareholders. And of course, Amazon also rallying on the back of very, very strong numbers, up almost 7% here pre-market. So pushing up to over $170 per share. So very, very strong move to the upside. My calls are going to be in the money. Should have closed them out just a couple days ago, but that was the only thing that I kind of missed out on, is closing out my calls on on Amazon. Now, Friday, we've got today ExxonMobil and Chevron. So they're also going to be reporting earnings, which I will break down in another video. So Vertiv Holdings LLC, I'll take a look. Vault here, Airbnb, your analysis. I've actually done an analysis on Airbnb before, so definitely do check that out. You can find another video. I think I did that a couple weeks ago on Airbnb. So we'll definitely do an updated analysis very soon. Srinivas, good entry points for Triple M, so 3M or GIS for the long term. So very quickly going over 3M here. We're looking at a support of around $92, $93. It's actually at a very good support here, 3M at the moment. So resistance is going to stay put at close to $110, $111 per share for 3M. So that is going to be that resistance and that target, with the support level staying put at close to $92 per share for 3M. And then for GIS, we're looking at a support, which is going to be General Mills at around $62 per share, with a resistance all the way up to $67. So General Mills, I still have to do a fundamental analysis on this company. I don't think I've ever analyzed General Mills. I've definitely analyzed 3M in the past, and it's a pretty solid defensive stock with a good dividend yield. But General Mills seems to have been sold off pretty aggressively from $92 back down to about $61, so 30% downside, with of course being really, really oversold on the weekly time frame as well. So there's potential there. It's trading at a support at $61. Ray, how many contracts? So I actually had 2 contracts on Amazon, covered calls at 160 strike, which are obviously in the money after today. I doubt they're going to come back below 160 here. You never know. You never know. Anything is possible. So there is possibility that they do end up, let's say, out of the money, by expiration. But if they don't, I'm totally okay with getting rid of some Amazon shares and kind of de-risking a little bit and, raising more cash at the moment. So that's going to be the idea. But of course, those calls right now are going to be in the money, and I believe it's going to cost me like at least $2 to $3 grand to kind of buy them back and close them if I want to keep my position. But that's okay. Like, that's one of the things with trading options, obviously, is that when you are selling calls, you have to make sure that your strikes are levels. First of all, rule number 1 is keeping your strikes above your cost basis. That's number 1, right? You cannot you cannot. I've seen so many people do this and make this mistake, is that they would sell a call, and they would pick a strike which is below their cost basis, right? So you can never do that. That's rule number 1. If you're doing that, that's a guaranteed loss, because if it ends up in the money, then you are pretty much guaranteeing a loss here. So rule number 1, definitely pick your strike that's above your cost basis. And rule number 2 is pick a strike that you're comfortable letting go of your shares. For me, I feel like 160 was a little too close to where the price was, especially going into earnings. So that's why I kind of made a mistake of a couple days ago when I should have closed out those calls, because they were up. Because what happened with Amazon was that it was trading as high as 161. Then it kind of dipped. The day even NASDAQ was down over 2%. It dipped back down to 159. I think 158 might have been the low on that day. So this right here, you see that red day when it traded actually down to as low as 144? What? How did I miss this? Oh God, 144 was the low. That day, my calls would have been up. I didn't even see it. And then of course, from those levels, Amazon ended up rallying to 170, which it's now up like 20%. So I definitely did make a mistake on that one. Should have been more attentive to the calls. That should have been bought back on Thursday, January 2nd. So actually, wait a minute. This is the weekly chart I'm looking at. This is the weekly chart. Yeah, my bad. So that's January 2nd. This right here, January 31st, is the day that I'm talking about. 154, not 144, 154. That's the level that we are talking about right now. So 154 would have been the low. But still, it was obviously lower than my call strike. So, okay. Let's take a look at unemployment. So 8 minutes. We've got unemployment coming out in 8 minutes. And that is going to be very, very important for the markets, of course. Crude oil prices, also keep in mind that in the month of January, crude oil prices were up close to 6-7%. So that obviously is going to play a role in the inflation report that is going to be coming out very soon. In fact, let's just quickly see when the inflation numbers are scheduled. So let's just go over to CPI here. Come down. So February 13th, so one day before Valentine's, February 13th is when the CPI numbers come out for the month of January. And we know that energy prices were up about 6% in the month of January. So that's going to be a little bit, that's probably going to affect the overall inflation as well. Everyone, make sure that you drop a like. I would really, really appreciate that. And subscribe to the channel if you haven't already. And do participate in the poll. So let's see if we can at least get up to 200 votes before the unemployment numbers come out in 7 minutes. So that is very, very important. Again, do participate in the poll. What do you think unemployment rate? Is it going to be higher than 3.8, at 3.8, or below 3.8%? So let us know in the live chat, and also do participate in the poll over here as well. So Vertiv Holdings, Vault, I will take a look at it during the live stream as well. Just kind of remind me after we're done with unemployment, and we'll take a look at it separately as well. Are you buying Google? Google is, in my opinion, a good buying opportunity here, considering how much it's sold off. And it's also trading out of support here. So I would personally look at Google as, yes, decent dollar cost averaging opportunity, but not something that I'm going crazy over, because my fair value from the most recent videos that you've already seen is a little bit lower. It's actually substantially lower than where it's trading at the moment, right? Low 100s is what I'm looking at for Google. So that is going to be that level to keep in mind. Enphase boom or bust on earnings. It's kind of a hard call, but I believe it's possible that it does drop further on the back of earnings, which are going to be coming out again on next Tuesday, February 6th. And again, we'll take a look at what those numbers end up looking like. So it's possible that it does drop here, just considering, you know, what the demand looks like for Enphase over the next couple of quarters, especially for the guidance for 2024. That's really what's going to guide, really dictate where the actual price action goes. Everyone, yes, do drop a like. Srinivas, thank you so much for mentioning that. Only 25 likes. Come on. I really appreciate it. Just drop a like. It takes literally less than a second, and really benefits us in a great way. Okay, what is everyone's expectations for unemployment here? So we got QQQs up here. We're going to put the SPY down right. And then, hold on one second. I was looking at the weekly chart before. Okay, so yeah, so we've got QQQs over here. We've got SPY down here, and we're going to put the 10-year yields on this bottom left screen, which are sitting at just under 3.9. And we're going to open up. I'm going to do an audio check as well. So let me know if the audio is good. So less than 4 minutes, folks, 4 more minutes, and we are going to get the unemployment report here. First unemployment report for the month of January for 2024. So Ryan, appreciate you. Your feedback has helped me add a bunch of 8 to 12% returns. That's amazing, man. Congratulations. Super happy, super proud of you. That's incredible, and I'm glad I was able to help. So congratulations. Marcus, watching from UK live, great video, mate. Keep them coming. Thank you so much, Marcus. I really appreciate you. And can I do cost average for Tesla at this level? My current average price is 156. Again, this is for long term. So depends. Like, what percentage are you looking to move the cost basis? Because if you've done majority of your buying in the 150s, then it doesn't really hurt, in my opinion, to add a little bit in the 180s. But if you buy 180s and it kind of significantly moves up your cost basis, then you may want to think twice, because 156 is a fantastic average. If it were me, I wouldn't personally touch it unless, of course, it dips below that level. And even if I were buying in the 180s, I would make sure that, okay, I'm not moving my cost basis too much closer to 180 or closer to the market price. Because, you know, you already have a cost basis which is closer to the average intrinsic value, in my opinion. And right now you'd be buying, which is slightly at a premium to its intrinsic value based on my assessment. So it really is, you know, a call that you can make. And if you're not moving your cost basis too much, then I think it's okay. Roshan, good morning. Caddy from Boston. Thanks for all videos and lives. So thank you so much for joining, Roshan. Really appreciate you, and I love Boston. Absolutely one of my favorite cities in the U.S. That's really where I most of the times end up being when I'm in the U.S. Either it's Boston or New York. Very rarely do I go to the West Coast, but thank you for joining in. It might be super early there, yeah, around 8:30. So 3 more minutes left for the unemployment numbers. Definitely do participate in the poll. 116 votes, folks. Let's see if we can at least get up to 200 here before the numbers come out. Apple, I will be doing an analysis on Apple here. We'll take a look at TMF as well, Nikhil. That's also on the radar. The 10-year yields have been kind of sticky. 3.8, 3.9, 4%. They've been kind of back and forth in and around those levels. So we'll be keeping a close eye on the 10-year yields and TMF TLT as well. TMF, of course, was a huge tactical play for us, for our community, and we did really well on that overall trade. And I exited, I think, in the 60s, somewhere in the 60s. And since then, of course, the stock price has, TMF has pulled back as the 10-year yields have kind of rotated back higher, and they're more or less stagnant in and around that 3.8, 3.9% level. Walt says, Caddy, yeah, I just wanted to say that after yesterday's Amazon jump after hours, I thought that now I'm up on Amazon around 70%. All thanks to you. Thanks to you, Caddy. I'll retire in 5-10 years. Thank you so much, Walt. I really, really, really do appreciate that, man. And really, this is what kind of warms my heart, is kind of watching all of you be successful when it comes to trading and investing. And look, my goal is for everyone to be conservative in a sense that you stay in the game long enough to see the potential for the market, right? The last thing I want to do is, kind of hype up or pump any type of speculative stock or non-profitable company. And because I know that might get the views, but it may not be the best decision for the audience, for the community, and for investors, because that's also kind of messing up with the mindset. So I'd much rather give you high quality companies. They may be conservative, right? They may not give you like 100%, 200% gain or return, but at least it's going to be more consistent. It's going to be high quality businesses that you can look at. Anyway, so we're going to switch over to the audio here and make sure the audio is good. So
85,000 jobs. That is the number to beat. Watch it. Ahead of the number, I want to welcome our jobs panel, Douglas Holtz-Eakin. He's American Action Forum president, former director of the Congressional Budget Office. Jason Furman is with us as well, Harvard Kennedy School professor and former chairman of the Council of Economic Advisors. Stephanie Link, Hightower Advisors, chief investment strategist and portfolio manager. And yes, our own Steve Leisman, as well as our own Rick Santelli. We've literally got 20 seconds before we get to the number to our good friend Rick Santelli, who has got the number in just 2 seconds.
Seconds. The first jobs report, jobs of 24 is out, and it is whopper 353,000. 353,000. We have to go in the Wayback Machine. That is the biggest non-farm payroll gains since January of 23, when it was 472,000. And if we look at the unemployment rate, it is 3.7. It's remained at 3.7. And just for history's sake, the 3.4 low that we had was the lowest since 1953. That was in April of last year. If we look at the average hourly earnings, a huge jump, up 0.6%, up 0.6%. It equals March of 22. To find a higher number, you have to go to January of 22. And also, for some context there, the amount of year over year is also popping 4.5%. We were expecting 4.1. The year over year average hourly earnings began as a data set in 2007, pre-COVID, all the way to when it started. The high was 3.6. It's 4.5. 4.5 is the highest level going back to February of 23. If we look at the average work week, 34.1, that is a drop. It's been at 34.3 or 34.4 going all the way back pretty much to beginning of last year. So that dropped 34.1. I don't even know if I have a record going back. That equals March of 2020. And 62.5 is the labor force participation rate. And if you recall, 62.5 was last month as well. It is going in the wrong direction. Finally, the underemployment, or U6, moved from 7.1 to 7.2. 7.2 is the highest level in that series since Dece of 21. Interest rates are popping, equities are dropping, and this is a report filled with strength surprises. And if you're thinking that average hourly earnings year over year or month over month is going to be something that Chairman Powell and the Federal Reserve Board studies, you're darn tootin', that's correct. Andrew, back to you.
Rick, thank you for that. I want to get straight over to our panel for some instant reaction. I see Steve's looking down at those numbers. Just want to get his quick take on how you're reading this, Steve.
This morning I told you there was a lot of talk out there about an upside surprise, most of it for seasonal adjustments. I can't tease out how much of this was seasonals at the moment, but the trouble is that you have surpassed what might be expected if this were all seasonals. And I would point, I hope Rick can back me up on this, because it looks like there was a massive revision to December from 216 to 333, as well as revising up November 182 to 173. I haven't had much of a chance to look at the detail. I did see that professional and business services were up strong. You had private education up 112,000, and leisure and hospitality just up 11. So a lot of that coming there. Government was 36,000. A lot of this was private sector. So I think a piece of this is going to be chalked up when we get a chance to do some work on these numbers, to seasonal adjustment issues.
126,000 two-month revision to the upside. And you're right. Early February, January jobs report always has some surprises.
But this one, especially because of the pandemic, Rick, and what's happened with that, the last January was all messed up, and so the season was messed up. We expected that. The trouble is, this is maybe almost 100,000 over the top forecast I saw that was already elevated because of the seasonals, plus the prior suggests we have some strength. And I'll just close it with this. Maybe Powell knew something on Wednesday when he said, you know what, March ain't on.
Okay, Jason.
Well, I don't know how much he knew, but 10-year note yields are down 26 basis points on the week before the number. Anyway,
Jason,
continue. I'm sorry.
Take me inside three offices this morning. I want you to take me inside Jay Powell's office. I want you to take me inside the White House. And then I want you to take me inside Trump headquarters. Who's cutting commercials and what are they going to say?
Look, the Council of Economic Advisors was the first place in the government to get this number. They got it midday yesterday. They then transmitted it to the Fed. Jay Powell had no idea this number was coming on Wednesday. But boy,
Jason,
does it
just
confirm.
to be clear, of course he didn't, Jason. Just want to be clear. I'm big in a joke there that basically making a comment that Powell had it right on Wednesday.
Yeah, no, they're not sitting there thinking like, oh, we need to cut now. I mean, there's two halves to the decision to cut. One is, are you worried about economic weakness? Yeah, maybe the January number was a seasonal adjustment, but you have the upward revisions, and you have jobs growing at a pace of about 300,000 a month over the last 3 months. You can't just put all of that down to seasonals. And then the one threat that remains to the economy on the inflation side is that the low inflation is maybe transitory, that we're not in steady state when it comes to the wage side, and you have that 0.6 up. Now, there's one weird thing in this data that I want to understand better. The one thing you didn't mention, Rick, that's on the soft side is hours were down 0.6%. It's really unusual
I did mention it.
Oh, you did mention it. Sorry. I wasn't listening carefully.
I did mention it.
But that means that weekly earnings were actually down, not up. So people are getting paid more per hour. Per week, they're actually taking home less. If they got, for example, the hours wrong and people worked more hours than they said they worked, then you wouldn't actually have had this big gain in hourly wages. So I think that's one part of the data that
productivity implications as well.
If it is as hot as it looks.
Doug,
so
I want to kick it over to Doug. I want to get his perspective on it, and I do want to understand again. And maybe it's a political question. If you're cutting commercials this morning in the White House or over down at Mar-a-Lago, what do those commercials say?
Well, I think the commercials from the White House say jobs, jobs, jobs. The president's created more jobs than anyone else. If you're down in the Trump camp, you're looking at that average hourly earnings and saying, look, we still have an inflation problem. Joe Biden created this inflation problem, and you've had to live with it. So I think that's the clean political read. I mean, the actual.
All right, everyone. So this was actually quite a surprisingly strong unemployment print. And not only that, we got a huge, massive, giant, I don't have bigger words, revision from the previous December report as well, because the prior number was also revised up from 216,000 to 333,000. So if you do the math, 333 divided by 216, that's a 54%. 5-4, not 15, 50% plus upward revision in the December number. Not only that, and for this report, we got over 100% surprise upside beat. Consensus was 170,000. We printed 353,000 jobs added in the month of January. So if you go over to the employment by industry, of course, majority of those jobs coming from the private sector, 317,000 jobs coming in from the private sector. Government was only responsible for 36,000 jobs, and most of it coming from service providing, 325,000. Decline in mining and lodging here. Construction slightly up 11,000. Manufacturing up 23,000. Wholesale up 2,100. Retail trade 45,000. Transportation warehousing 15,000, professional business services 74,000, private education health services 112,000, and leisure hospitality 11,000 as well. So utilities did not really grow that much, 1,800, information 15,000, financial activities and services 8,000. So private sector absolutely on a roll, and this is right after the holiday season, so it's kind of possible that that there's some seasonal adjustments that they were talking about, but if you plug in these numbers, with the unemployed persons now sitting at 6.12 million, JOLTS coming in earlier in the week at over 9 million. We're looking at a ratio of 1.47, which is now trending back up once again, because we obviously did have over 6.4 million unemployed persons in the previous month. And then we had a little bit over 8.5 million JOLTS. So we're looking at 1.33. It was coming closer to that equilibrium of 1, and now we're moving back in that other direction to 1.47, meaning that there's almost 1.5 jobs for every one person that's unemployed. Now, why did the market sell off? Should be a fairly easy question. Everyone should have the answer to this question. Everyone watching this right now should have the answer to this question. Why did the markets sell off on this news? Why did we see the NASDAQ drop over almost 0.5% and the S&P also dropping 43 basis points, with the yields jumping back up to almost 4%? Why did that happen? So Simple Piano Learning is asking, so is this bad for the market? Everyone should have the answer to that. The answer is yes. It is not great for the market. It is quite bad for the market. And what is the answer to that question? Everyone, 350 people watching this should know this. Should be pretty obvious. We've talked about this over and over again. So Jenna says the market will rally means more dollars in consumers' pocket to keep their earnings up. So actually the average hourly earnings was actually up, but the average work week was down. So if you come over, take a look, we actually saw 34.1 hours versus 34.4 hours, which was the consensus. So we saw 0.3 hours less, which is 20 minutes, I think, 0.3 of an hour. 30% of an hour is about 20 minutes, 25 minutes. So workers were working 20 minutes less in an average given week. So they are actually taking home less money, even though average hourly earnings were up 0.6%. So they're making more per hour, but they're working less. So it's possible that either the take-home pay was neutral or somewhat down, considering that the average work week was slightly lower than the previous number and the consensus as well. But we saw 4.5% wages increasing 4.5% on a year-over-year basis. So coming back here, so rates higher for longer. Again, no rate cuts anytime soon. Absolutely right. So you guys are absolutely bang on with that expectation, because that's what the market is somewhat pricing in. And, Jerome Powell kind of mentioned on Wednesday that, when it comes to the rate cuts, the timing of the rate cuts is the big question, right? When are they going to cut rates? Because he mentioned this, and I quote, "If unemployment weakens, it will weigh more towards rate cuts sooner," right? So what does that mean? That means if the unemployment rate starts to weaken, if we see some softening in the labor market, then they are going to look at cutting rates sooner. But if inflation stays sticky or stays elevated or above the Fed's target, that's going to weigh towards rate cuts later. So those are the two forces kind of fighting against each other. And the fact that the unemployment is not weakening and it's super strong, And if inflation continues to come in somewhat stagnant, somewhat elevated above the Fed's target, with core PCE, of course, sitting at almost 3%, which is 50% higher than the Fed's target, then that obviously tells you what? That, they're not done yet. And that's exactly what he mentioned. He said that we cannot declare victory. We're not obviously done with what we want to achieve with our objective of bringing inflation down. And as a result, the timing of those rate cuts is still unknown. It's a big question mark because the markets originally were pricing in for rate cuts starting in March, which got pushed out to May. That's where the markets are right now. That's 61.8% probability that the first rate cut's going to take place in May. But it's possible that keeps on getting pushed out maybe to the second half of 2024 if unemployment and the economy continues to be super strong and inflation does not come down to the Fed's target. Because, they're pretty adamant. They want inflation at 2%. Like Powell and the Fed, they're not stopping until inflation comes down to 2%. So it really is going to come down to either inflation comes down to 2%, unemployment starts going up, or they both have to happen at the same time in order for the Federal Reserve to be motivated, to be incentivized to cut rates. So basically it's three things. One of those three things needs to happen. Either unemployment starts going up, or inflation continues to come down to 2%, or they both happen simultaneously at the same time, and that's going to be a good incentive for the Federal Reserve to cut rates. If none of those three things happen, guess what? They've got no incentive. They've got no reason to be looking at cutting rates. Because, again, they are looking at 2% inflation, which Jerome Powell once again reiterated time and time again. And he also mentioned that we cannot declare victory, and we still have ways to go to bring inflation down. So King Ba says no cuts until second half of the year or earliest May. By March. Yeah, so March, in my opinion, is already gone after the employment report that we got, unless it all boils down to the inflation numbers, because the March meeting is actually later. So March meeting is towards the end of March. So it's not before the inflation of March, it's after inflation of March. So the only way I see a March cut being the start of this pivot is if the next two inflation reports come in super strong, suggesting core inflation to be under closer to 2%. So if you come over to subjects here, consumer price index, the next print is going to be on February 13th, so a day before Valentine's Day. And if you go over to the charts, you'll notice that right now we still have core inflation, which is more or less stagnating to the side. So this right here, it is trending lower, but it's still at 3.9, right? So that's CPI, but I think core PCE is closer to 2.9 or 3%. So if it keeps trending lower, that's good over the next couple reports, because like I said, the next Fed meeting is 47 days from now. So if you go over to the Federal Reserve website and we take a look at meetings and calendars, the next meeting is actually on March 19th and 20th. So March 19th and 20th, I believe inflation numbers are scheduled way before that. I think it's going to be in the second week of March. So the Federal Reserve will have two inflation reports to analyze before deciding whether they cut rates in March or they cut rates in May. But inflation, like I said, continues to be a little bit more stagnant, and employment continues to be so strong, then I think the possibility for a March cut is getting less and less likely. So, yeah, I mean, there's definitely political pressure, and it's an election year, you're right, and election year is definitely going to create that political pressure for the Fed. But, I believe there was a more political pressure when Trump was in office as opposed to when Biden's in office. But you're right. There's definitely going to be some pressure on Jay Powell and on the FOMC to cut rates because that's going to create a much easier environment for consumers, and that's one way to get a lot of votes. But Jerome Powell and the FOMC's mentioned before that they operate independently of who's in charge or who's in office. So, but we all know, I mean, that's never the case. I mean, there's definitely some influence behind the curtains, but in my opinion, I think it's going to be more of an inflation/employment narrative than opposed to a political narrative. But we never know. We just never know. So Thomas says another rate hike incoming. It's going to be very well. The only thing that's going to create a rate hike is what? Jay Powell said this. Jay Powell said this one thing, that the only way. So he said this: we want to keep our options open, and we may start looking at accelerating sort of interest rates. We want to keep them where they are, or might even consider hiking. He didn't really mention this, but that's what he was hinting. Only if what happens. Only if what happens. So fill in the blank. Blank happens, and that's why we're keeping our options open, and we may consider, once again, looking at increasing rates moving forward. So what needs to happen in order for the Federal Reserve or Jay Powell to start thinking about hiking rates once again, which obviously would be a disaster for the market because we will just go from 6 rate cut expectations to a potential hike. That's a huge U-turn, which is obviously going to be a pretty big problem for the market to deal with. But that only happens if blank happens. What is that blank? I want to know from all of you. So definitely do comment in the live chat what you think. So Indy Ballin says increased sticky inflation. I want to hear from more people. Inflation doesn't come down, it goes up, Lee says. So I'll wait for a couple more people here. Inflation reacceleration, absolutely, right? So all of you guys are right. If inflation starts to accelerate, back up, that is when the Federal Reserve will start considering more rate hikes, which would absolutely be a problem for the market because, like I said, it would be a huge U-turn from 6 rate cut expectations to a hike. That's not going to be good. So how many people here believe that that inflation is on its way down? I want to hear, let's just do a quick poll on what people believe inflation. Let's just do 1 year, inflation in 1 year. Let's just do this. Inflation at the end of 2024. At Fed's target of 2%. We'll do at Fed's target of 2%. Above Fed's target of 2%. Or below Fed's target of 2%. So I want to do this poll. I want to see what everyone thinks where inflation will be at the end of 2024. And this is on a year-over-year basis. We're talking annual inflation for entire year 2024. You think it's going to be at the Fed's target of 2%, above the Fed's target of 2%, or below the Fed's target of 2%? Let us know, everyone. So we'll have a good data set. We'll kind of understand what everyone's thinking in terms of this this poll. Because at the end of the day, this is really what's going to dictate where interest rates go, keeping everything else constant. If the scenario basically runs something like inflation's first, then we look at the economy, we look at the unemployment, and that's when we look at where interest rates are potentially going to go. But the 10-year yield's almost at 4%, up over 2.7, and the dollar index pushing up to 103.67, up about 0.5%. So Enesila says inflation up, employment down. Crap hits the fan. We got 74% right now. People expecting that inflation is going to be above the Fed's target of 2%. It's going to be a little bit more sticky than usual. Yeah, this says I don't think it'll be too much higher, but it will remain sticky or tick up a little bit from here. This sounds bad for both Tesla and Enphase. Yeah, I mean, if interest rates stay higher for longer, that obviously is going to be bad for interest rate sensitive stocks, including Tesla and Enphase. And then, of course, not to mention big tech, Magnificent Seven companies and stocks are also going to get affected by it. So yeah, that's where we are. Unemployment numbers with a huge, shocking surprise to the upside. Coming in with a massive beat on overall non-farm payrolls. Unemployment rate 3.7. Again, private payrolls 317,000, and average hourly earnings also growing significantly on a year-over-year basis. Let's see if we can at least get up to 100 votes here, folks. Definitely do participate. Above the Fed's target, 2%, 77% right now. That's how many of you expect inflation at the end of 2024, to be above the Fed's target of 2%, which obviously is not going to be great news, but maybe to chill out a bit, let's just analyze Vertiv Holdings. Let's just take a look at this stock here very quickly. VRT is the ticker symbol. Looks like a fantastic uptrend. So, wow, look at this company here. From April of 2023, the stock's up whopping 416%. Very, very small yield, a $22 billion company. We've got pretty good revenues and profitability, low margin business. So I'm assuming it's not a software stock, it's not a software tech company, but mostly I think a hardware or manufacturer. So engages in design, manufacture, and service of critical digital infrastructure technology that powers, cools, deploys, secures, and maintains electronics that process, store, and transmit data. Interesting. Where are they based out of? So they are headquartered in Columbus, Ohio. Okay. So earnings expectations from $1.75 to $3.27. That's about almost 100% increase. Revenue expected to go from like sub $6 billion to almost $9 billion. It's a 50% growth. Valuation's quite high at over 30 times cash flow, 86 times earnings. And we've got a balance sheet which has a positive net debt. And free cash flows are a little bit inconsistent, I would say. More recently, though, quarter over quarter, they're up. 2022 negative free cash flow. Very, very overbought vault, so I'd be careful here. RSI, of course, kind of staying up there, pretty overbought for quite some time. So on the weekly time frame, even on the monthly time frame, I feel like it's definitely something to be aware of, that it's incredibly overbought at the moment. And valuation is also a little bit on the higher end. Type as which stocks do you think are currently good to buy? Apple at 180 maybe, or some other shares. So Apple closer to 160 would be good in my opinion. And then of course other companies, looking at the valuation wise. So if you're looking at momentum, and if you're looking at a lot of strong sentiment and momentum here, of course Meta and Amazon and sort of Nvidia, AMD has got the trend, got the momentum going for it. But they're only, right now in my opinion, they're only trading opportunities because it's only a matter of time until the music basically stops, and we see a little bit of reversal. So that's something to keep in mind. But if you're looking for long-term investment opportunities, looking for companies and stocks that are trading at values that are, relatively speaking, to their earnings and revenues are quite reasonable, then of course my stocks are going to be Enphase and PayPal, even Tesla to some extent, given how much it's sold off, seem pretty reasonable compared to their intrinsic value. InMode is also one that I like, but the only concern here is that InMode doesn't have a recurring business model just yet, right? It's very, very capital equipment. And of course, if they're not able to sell as much, they don't have a recurring subscription model which they can rely on. But it's got one of the best balance sheets. I mean, more cash than all liabilities combined. It's got like over 10 times more cash than all liabilities. So it's got a pretty solid balance sheet. So bankruptcy risk is really low, and very strong, consistently growing revenues and profitability as well. But like I said, the only concern here is the subscription model, or the recurring business is not that much. Other than that, I mean, there's a lot of cannabis stocks that are on the move now. So if you take a look at TrueLeaf, I mean, it's done really well over the last couple months here. In the month of January, it was up like 85%. This month, it's up another 12% already. So we're seeing a lot of momentum in cannabis stocks. So those are some also places to look at moving forward as well. All right, everyone. So 76% of you expect inflation at the end of 2024 to be higher than the Fed's target. So that obviously is going to result in maybe rate cuts later if the Federal Reserve does not achieve their goal of getting inflation down to their target. Bristol Myers, this is the overall analysis where it's got a pretty solid trend. Support level is going to stay put at $44 and resistance all the way up to as much as $76. So a lot of consolidation in that range for Bristol Myers. And again, lots of demand here at those prices. On a monthly time frame, it's coming down, pretty oversold. So I think it'd be worth looking into this stock at $44, $45 with a pretty strong yield also coming in for the company. And annual revenues, of course, growing quarter over quarter, also pretty stable stock, stable company here. The Leap, I feel like a lot of companies are going to be down today on the back of these strong unemployment numbers, so I wouldn't read too much into it because you can already see the NASDAQ kind of giving up on all the gains from pre-market here on the back of such a strong unemployment report. So we're already starting to see a little bit of that pullback here. And SPY is pretty much flat. At one point, it was up close to 1%. So it's already flat now, and the yields are now back over 4%. So Enphase is down. Tesla's probably down as well. I haven't looked at Tesla, but pre-market, I'm assuming it's going to be down as well. There we go, down 2% on the back of yields pushing higher, and pretty much, these two indices selling off on the back of the strong unemployment numbers that we just got. So that's going to be it for today, everyone. I may go live later in the day as well to kind of cover during market open, cover a lot of individual stocks. So stay tuned for that as well. Hope you all enjoyed this video. And again, the employment numbers coming in super strong. Huge surprise beat on non-farm payrolls, and unemployment rate sitting very steady at 3.7%. So we're dealing with a very, very strong labor market right now in the United States. So I hope you all enjoyed this video, found it helpful. Make sure that you drop a like, and definitely do subscribe to the channel here. Amazon and Meta have got earnings analysis coming out later today. So we'll be doing videos on both of those companies, dedicated videos on both of them. And as always, make sure that you drop a like, subscribe to the channel. Links to our Discord, Patreon is going to be down below if you want to join, be a part of our MoneyVest community, and again, engage and interact with everyone else